Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Nvidia. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call spread in Nvidia. I currently have the long call spread inside the Options Playbook website up. And what a long call spread does is it buys an option contract that is more expensive and sells an option contract that is less expensive. One of the biggest benefits of a long call spread is that you have less susceptibility to volatility fluctuations and also to time decay issues when trading option contracts. Why is that? Well, you're buying an option contract that is fighting declines in implied volatility, also battling time decay issues, where you're selling an option contract that benefits from both of those things. So by doing a long call spread, especially on expensive stocks like Nvidia, you are trying to combat those pressures of option trading. So as far as Nvidia is concerned, the stock has done fairly well, but I want to take a moment to look at the marketplace and just highlight one thing. Normally, I don't review the markets or what we talked about on Tuesday, but I'm going to run to my Ally Invest watch list. And we see that the VIX right now has came down precipitously. It's down at 2252. It's up a little bit on the day to day. And that's because the SPX is down just a fraction. Now, I'm surprised with the geopolitical concerns and also the risk of inflation that we have and the fact that we have inflation, period. It has really, the marketplace seems timid about those major events that are happening in the world. So we do see interest rates on the 10-year just setting a new high. We got the interest rates right now at 2.4% on the 10-year. That's the TNX SIBO interest rate. It tracks the actual percentage that the 10-year is trading at. So it's 2.482% right now. So that's a new high since going all the way back to 2018 before we've seen levels that high as far as the 10-year is concerned. And but we have a real positive chart as far as the S&P 500 index is concerned and a lot of the other indexes. But I do want to highlight one thing in the chart before I get to the Nvidia trade. So if we look right now, I just drew a Fibonacci on the S&P 500 index. I'm going to scroll down just a little bit on this chart. And you see that if I put my cursor over it, it makes the Fibonacci numbers red. And what we talked a little bit about this breakout, and it was a solid breakout of the trend line that we had drawn a few shows back. And it had really three solid candles. And then a fairly big event was when we passed through the 200-day. So the market came back, passed through the 200 days. Since the downturn from here on down, if you draw a Fibonacci, you see that, well, we came back 50% of the downturn, which is just solid in general. And we also now are bumping up against the 61.8 level. Now, if we can break through that level, then, we're looking all the way back at the next level would be that 100% retracement. So as far as the Fibonacci's are concerned, these are positive numbers, and I just thought I would highlight them today. The fact that we came all the way up to that 50% level, right where the 200-day is, and we've broken through that. Now, if we stay in this range, 61.8 is feasible that's what the rules of Fibonacci basically say. So let's get into the stock play of the day. This is overtime. This is what we're here to talk about. And we're looking at Nvidia, what happened with Nvidia this week. So we tape the show live on Tuesdays at noon Eastern time. So we're always dealing with live markets. So this is a 15-minute chart. and this is noon Eastern time on Tuesday. So for the rest of the day, the stock actually traded down, and we were bullish. We did a long call spread. Market kind of, well, you'd say it's down a little bit, but this isn't a huge move. You're going down to about the 260 level. Yes, the day following on Wednesday, it went up to 265, and it closed right around 260. And then since that time, it's made a very strong move to the upside. And now we're selling off just a little bit. So the one thing that has been very true about Nvidia, and it's been true over the last 6 months or so, is that there's a lot of volatility in it. And there are a lot of question marks in the semiconductor industry, except for the fact that there is high demand for semiconductors. They're having problems meeting they have supply concerns. They're having problems meeting that demand, but that's a nice problem to have if you're a company in general. So if we look at this is what has happened with Nvidia. It's obviously up. So let's see where our long call spread is at. And we'll talk a little bit about what we do from here. But when we do stock plays of the day, nothing's ever meant to be a recommendation. And nothing's meant to be a recommendation. And one of the things is when the stock goes up, there's not too much to talk about, or when the stock goes in the direction that we like, there's not too much to talk about on the stock play of the day. So I'm just going to look at a potential closing position because we are up on it. We're not going to look to adjust this trade. So if I go to the Ally Invest option chains, we have calls and we have puts here, and I've already gone to the expiration date that we were looking at. The May 20th expiration date, it went out 56 days. I'm going to scroll up kind of slowly here. So goes out 56 days. And I did talk about the time frame. This is an expensive underlying. We also talked about it in Google not that long ago on expensive underlyings. If I'm really like more bullish on the stock, I'll go out further in time as opposed to a pure speculation play that might be based off of a chart pattern. So this is just a more bullish play because we went out further in time, but it does hurt the profitability of the trade if the stock moves too quickly in the right direction or in your direction as far as your forecast is concerned. But right now we went out on Tuesday, and the paper trade, the screenshot that I have, we bought, well, let me talk about the trade first of all. So we got the May expiration, we bought the 270 strike call, and at the same time, we sold the 300 strike call. So it's a very wide spread, and that's also, if I'm going out further in time, I like to widen my spread, but I'm doing that because I'm leaning more bullish on the underlying stock as opposed to just a short-term pattern. And if we look at this spread, we ended up paying on Tuesday, the midpoint was at $10.55. So that was our official paper trade for the week. And now we see that we're up a couple of bucks on that. So now it's trading at, well, it was up, it's down just a smidge since we started the webinar. We're at 12.28 now at the midpoint. So just shy of a couple of dollars. So how would I approach this trade now? And normally if I have especially a longer dated call spread, I will always have an order to sell on the upside. Now, we're managed our risk by the fact that we have more upside than downside on the long call spread. We were paying $10. The maximum this could trade for was around $30. So a little bit more than $10, but so we're paying about a third of what we could make, and that was a goal, and that was a way to manage risk. So you don't necessarily have to watch it on the downside because you manage your risk by the way you set up the long call spread. Now on the upside, I want to be able to get out. I don't want to miss an opportunity if the underlying market does. Let's say it just we get a big jump up, a big spike up above 300, and you have an opportunity to get out at close to the maximum. If that were the case, I want to have a standing order in. So today on the stock play of the day overtime, we're just going to talk about closing the spread. This was the initial spread. We bought to open the 270 call. We sold to open the 300 call. I click the trade button here inside the Ally Invest option chains, and it opens up a right rail that has that order. We see where the underlying stock is at. It's actually getting beat up a little bit right now as we speak. It's down $7.41 right now. But we do the exact opposite of what we did when we entered the order. So we have a buy to open. Guess what? That becomes a sell to close. And then we have a sell to open, and that becomes a buy to close. We still see the market. We see it at trading at a $12.33, but highlight the fact that it is now a net credit to the account. I'm going to click on that, and that will make it a limit order. But now I'm not looking to make $2 on the trade, because if we want to do that, we just sell it right now and get out of the marketplace. But I do know the maximum it can trade for is around $30. I don't anticipate getting that $30, but I want to, if it gets anywhere close, I want to have an order in, and we're going to put this in good until canceled. So I would look, maybe, let's say, pick a number, $26, not quite 30. I don't want to put in 30 because it's very hard to get that $30, the maximum on that trade, because you have one option contract that you sold that doesn't want the market to go up, and one that you bought that wants the market to go up. So they fight each other until they get closer to the expiration date, if that makes sense to you. And I'm going to hit 26. So we're going to pick 26. We're going to make that good till canceled order. It's not a prediction of where the market's going, but if it does go there, I'd be happy to get out at 26. Now, the only thing we have to change now is the duration. We're going to keep that in as a good till canceled order. And then we click preview, and that would be our, well, I guess this would be our follow-up paper trade in our Nvidia trade. But this is how I would handle this trade. I put this trade in. I'm a little bit more longer term on this than most of my long call spreads. It's not just a speculation play. It's more of a fundamental play that the demand will still be there for semiconductors, and they'll be able to meet the demand better as we get into the summer months. That's kind of the outlook for it. And so we put in a good till canceled order to get out at a price that we wouldn't mind selling at. We can adjust that order later if we'd like to, but right now things are going good. Why wouldn't we just keep that order in until the market potentially moves up to that level? Okay, so I also wanted to highlight Google, because we did a very similar trade in Google, the same rationale behind it, and that's what the stock play of the day is all about. Is we want to take plays. There's over 40 plays in the options playbook, the book that I authored, and apply them to different underlyings and there's no perfect option trade, but if you're trading more expensive stocks, I'm going to lean towards doing spreads as opposed to less expensive stocks. And Google is definitely a more expensive stock. They're going through a stock split, and that's kind of what we were targeting with Google. And we didn't have a stock play of the day overtime because actually I was out of the office on that day, so we did not have one. So I want to go back and look at Google and talk about that trade that we did a few weeks ago in the stock play of the day. Google, at that point in time, we were targeting the August 19th expiration, which is the expiration after the split in Google. They're looking to split 20 for 1. Google right now is down 19, but it's up quite a bit from when we looked at this long call spread. The stock was at 2,589. That's where the stock was at. Now we're at 2,811. And we did a real wide trade. We went 30 points again. So 2,700 was the strike that we bought on that August 19th expiration. And we highlight that here by our little checkbox over here where we put a B in there. And then we sold the 3,000 strike expiration. And at that point in time, that was trading for 104. And we see this trading for 149. So we're up 49 points on it. Since we put the trade on to start with. So you might think about getting out if you would like to, but at the very least, once again, if this is trading if this is trading at this level and we have a decent up move or a decent up move in the underlying stock, why not take this opportunity to put in a good till cancel order, see if that market continues to move? So we could say that we'll go with the $26 thing. We'll keep it the same as Nvidia. We're going to sell to close. This would be the way I would look at the trade. We're going to, instead of sell to open, we're going to be buying to close. Net credit, it looks like 150 in the account. So if we're going to come on in and look at that trade, we're going to probably, well, you'd have to pick your number. We'll do 250 in this instance, and we will make that a good until canceled order. And that would be our paper trade for Google on a good till cancel basis if we got that market to actually move up in price. So that's it for this edition of the stock play of the day overtime. On Tuesday's stock play of the day, maybe we'll look at another trade. We've got another stock splitting, a little known company called Amazon. And maybe we'll look at a long call spread in Amazon just to address and keep the theme going with these long call spreads on expensive stocks. Thanks for coming, everyone. Click subscribe. Please ring the bell, and we'll see you Tuesday for the next stock play of the day. Bye, everyone.